Right now, the S&P 500 is at a record high, the Dow Jones is at a record high, the Nasdaq is at a record high. The big question on everybody's mind these days is, should they invest now or wait? Is there a stock market crash that's coming? And if so, is there a way to predict it? In this video, I'm going to explain in depth 4 signs that have helped predict a stock market crash and help you decide whether or not you should invest now or wait. I'm going to go through each indicator, tell you what they measure, exactly where they stand currently, how they have performed historically in predicting stock market crashes, as well as tell you about what their shortfalls are. And then finally, I'm going to share exactly how I am investing personally based on this information. Now, some of these stock market indicators will build off of one another, and so if you're new to these concepts, you might want to watch them in order. But I will add the timestamp down in the description below, so feel free to jump ahead if you want to. The first indicator is known as the Buffett Indicator, and this is the ratio of total US stock market value divided by the GDP of the United States. The stock market value represents what is expected to be the value of future economic activity, which is why expected earnings is such a big driver of the stock market. On the other hand, GDP measures current economic activity, so it captures all the value produced by the economy. So the ratio of these two metrics tells you the expected future economic growth relative to current economic growth. Therefore, the higher this ratio, the more likely the stock market is getting too far ahead of the economy. And so that means that there's a higher chance of a painful stock market crash to get it back aligned with the real economy. According to current market valuations, right now the ratio stands as follows. So the aggregate US stock market value stands at $47.4 trillion. And here's the growth of the US stock market value since 1950 up till now. This comes from the Wilshire 5000, which is a market cap weight index of the market value of all American stocks. And it actually only contains 3,500 companies, not actually 5,000 companies. The current GDP stands at $21.7 trillion. And this chart here shows the nominal growth of the US GDP since 1950 up until now. With these numbers, the Buffett Indicator is at 218% as of January 28, 2021, which is actually 79% higher than the historical average. Based on the historical trend, the fair value should actually be around 120%. The last time the ratio was at the historical average was back in 2013, and we've been mostly moving away from the average since then. Another way to look at this is to use a regression line that shows how far the ratio is from the historical average at every point in time to figure out how far off is 79% relative to other time periods. And when you do that, you get this chart. These standard deviation lines you see here tell us the probability of the ratio being this far from the average. So currently being beyond 2 standard deviations tells us that the current stock market is very much a statistical anomaly. So you might think that based on this, that the stock market is about to crash at any moment, even more so than the internet bubble back in 2000. But there's more to this stock market indicator that you need to know. The real test is how good is this in predicting a stock market crash or a recession. So here's the same chart with the recession shown in the gray vertical bars. And again, here the red dotted line shows the historical average of the ratio. The 2008 stock market crash barely deviated from the average. And prior to this, arguably, the ratio might have been a warning sign for the stock market bubble in early 2000. But other than that, the argument is tough to make. Moving further back in history, the ratio doesn't seem to hold much predictive power. And that's because there are other factors at play that this ratio just does not take into account. So this leads me to the first criticism of the Buffett Indicator, and it has to do with this top part of the equation. US companies derive a significant portion of their sales overseas. The impact of globalization clearly shows in the revenue mix of the biggest US companies since early 2000. Between 2000 to 2010, foreign sales of S&P 500 companies has only gone up, and in more recent years stands north of 40%. More importantly, beyond revenue, foreign sales is a key driver of S&P 500 earnings growth, and you can see that it has been trending up as well. So this means that the ratio is not as reliable because this stock market valuation incorporates forward earnings from economic activity not realized in the United States. So basically, this inflates the ratio in more recent decades. Another issue is the value of assets outside the stock market. If you think about it, investors are free to choose to invest in other asset classes like bonds, real estate, commodities, even cryptocurrencies. The ratio does not account for the value of these other assets relative to stocks. And investors will flock to the asset that basically gives gives them the highest return for their money. So a big argument for why the ratio doesn't work well in the current environment is that interest rates today are at record lows, making bonds very unattractive compared to stocks. And this chart here shows a correlation of the 10-year bond rate compared to the Buffett Indicator, and it shows the indicator generally moves in the opposite direction of the bond rate. The next indicator is really important and you don't want to miss on this one. It's called the LSN, and this might be the most important indicator that every investor would highly recommend you take action on. And it stands for smash that like button, subscribe to my channel, and hit that notification bell. I just couldn't resist sneaking in here, but yeah, I really appreciate you watching this video, so let's keep going. All right, the next real indicator, it's called the CAPE ratio, and this stands for the cyclically adjusted price earnings ratio. And it was proposed in 1999 by Dr. Robert Shiller, who is a well-known economist from Yale, and it's a modification of the traditional price earnings ratio. The PE ratio is one of the most basic measure of a stock's value and is very frequently applied to the broader market as well. So for individual companies, the ratio takes the stock price and divides it by the annual earnings, which basically tells you how many years of earnings it takes to get back your original investment. Another way you can think of it is the price investors are willing to pay for a certain amount of earnings or return. To apply this to the entire stock market, we add up the price of every share in the S&P 500 and add up all the earnings per share of these companies. This gives us the basic PE ratio, and this is how these two metrics have trended over the last 120 years. If we take the ratio of these metrics, this is the PE ratio of the stock market. Now there's a lot of volatility, so we want to modify to smooth out the big spikes. And so this is where the quote unquote cyclically adjusted part comes in. Instead of taking the most recent total earnings, we're going to divide today's price by the average earnings over the past 10 years. And if we do that, this is what we get. It still has quite a bit of volatility, but it's not as extreme as before. But to make this more relevant in today's context, to predict the next stock market crash, we should really zoom in on the more recent years, because there's a big difference in applying this ratio to the 1921 stock market versus the 2021 stock market. One of the big reasons is that the S&P 500 didn't exist as we know it today until the late 1950s. So it makes sense for us to look at this from a starting point of say 1950. So if we zoom into this chart and add the standard deviation lines, this is what we get. As of January 29, based on the CAPE ratio, the stock market is 71% above its historical average, which means the stock market you might think would be overvalued. During the stock market crash of 2008, the ratio was hovering around one standard deviation above the average. The ratio hit a record high of 132% above the mean during the dot-com bubble, but then prior to that, it's really hard to identify any market crash by this indicator alone. There's a 1990 recession, the stock market crash of 1987, the twin recessions starting in 1980, the 1973 bear market recession, the 1970 recession, and on and so forth. For each of these corrections prior to 1995, the stock market wasn't anywhere near overvalued based on the average. So from what the CAPE ratio is telling us, are we going to have a stock market crash? Well, the answer is not that simple, because just like the Buffett Indicator, this doesn't factor in the effects of bonds and specifically low interest rates. Here the blue line is the CAPE ratio and the red line is showing you the 10-year treasury yield. What you should take away from this is just how low the interest rate is historically. And because rates are so low, investors are ditching bonds and crowding into stocks to get a better return. So while the CAPE ratio is around 33, 34 right now, and it seems really high historically, it was more than 44 during the internet bubble of 2000. And at that time, the 10-year treasury yield was 6%. 6%. Right now, any investor would jump on a risk-free yield of 6% in a heartbeat. Most younger investors like myself don't even know what it feels like to get a 6% return risk-free. YouTube and TikTok will be choked full of bond investing videos if yields were that high. So yeah, with yields close to zero, it shouldn't come as a surprise that stocks are incredibly attractive right now and that demand is going to push valuations up. But then the question is, how much more can the stock market go up? To try to address that concern, in November 2020, Robert Shiller released this article that introduced a brand new metric, which takes us to the next indicator called the excess CAPE yield, or ECY. This simply takes the inverse of the CAPE ratio, which becomes an earnings yield, or you can think of it broadly as the average stock market return. Then we subtract the 10-year bond yield, which then tells us how much higher stock market returns are compared to government bond returns. If you plot this out over time, this chart is what you get get with the blue line showing the indicator and the green dotted line showing you the subsequent 10-year returns from that additional yield by investing in stocks instead of bonds. So yeah, by taking into account the incredibly low bond rates these days, this indicator basically normalizes the opportunity cost for investors in choosing between the two asset classes. With a current yield of 3.8%, the ECY would suggest that the stock market is not in a bubble, and the market valuations we are seeing these days are reasonable, even though they seem so expensive when we just look at stocks historically in isolation. The next stock indicator is called the inverted yield curve. Now, the yield curve has nothing to do with stocks, but it might arguably be the most reliable sign of a stock market crash. But before you get too excited, it has its limitations, which I'll get to later. So let's talk about what is the yield curve and why it would invert. A yield curve is a graph like this that shows you the yield of bonds at different maturity dates. And typically we are talking about US Treasury bonds. So here, a 2-year bond yields 1%, a 10-year bond will get you around a 4% yield, a 25-year bond will get you a 6% yield, so on and so forth. And almost always, shorter term bonds have lower yields or returns than longer term bonds. And this is because the shorter the bond, the less risky it is. The longer the bond maturity, the more risk the investor takes on. And that's because there's a lot more stuff that could go wrong in 30 years than in 2 years, like higher inflation, a recession, a depression, war. We can even throw a pandemic into the mix while we're at it. So by connecting the yields of different maturity dates, you get this upward sloping curve. So then why would this curve invert and look something like this? This means investor demand for longer term bonds increases as a flight to safety, which lowers the yield. This usually happens when investors expect the economy to slow down or have low growth, which means low return on stocks or other assets. And so the higher yields on longer term bonds become really attractive, and they buy up those, which drives the yield down. On the other hand, demand for shorter term bonds falls relative to longer term bonds, and that drives the yield up. So an inverted yield curve clues you in to the behavior of investors based on their expectation of what might happen to the economy. So how reliable is it at predicting a recession? If you take a look at this chart, it is showing you the yield spread between the 10-year and the 2-year Treasury bonds. So normally the 10-year yield is higher than the 2-year yield, which are positive percentages up here. But then every once in a while, the 10-year yield is actually lower than the 2-year yield, which means it is negative, and those points in time show up at these spots. And as you might have guessed, these dips happen just before the gray vertical bars, which indicate the last 5 recessions. Here's the stock market crash of 2008. Here's the stock market bubble of 2000, the dot-com bubble. Here's a recession in early 1990. And here's the twin recessions from early 1980. Since the 1970s, this dip has happened prior to every recession, which is an incredible track record for predicting a stock market crash. But there are 2 big shortfalls that you need to know about this indicator. First, there is a big lag from the inversion to an actual recession. For instance, during the 2008 financial crisis, the yield curve inverted 14 months before the stock market peaked and crashed. And based on this historical analysis by CNBC, a recession arrives on average 22 months after the inversion. Another problem is that sometimes the inversions can be a false alarm, and it's hard to judge if it should be taken seriously. Take for instance the inversion that happened in 2019. This animation shows the movement of the yield curve in the months leading up to the inversion in March 2019. Coincidentally, the COVID recession hit 1 year later, but if the pandemic didn't happen, would we still have had a recession? And honestly, no one knows, but we know historically that since 1960, there were 2 false positive inversions, one in 1965 and one in 1998. So yeah, the yield curve can invert with no recession, and even if there was one, it could be almost 2 years away. So where does the yield curve stand today? As of February 5th, the 1-month yield is at 0.02%, while the 10-year yield stands at 1.19%. And you can tell from the curve, it is nowhere near an inversion at this point. In fact, a steep yield curve looking like this is more characteristic of an economic recovery and expansion. So with all this information, you may be wondering, what am I doing with my investments? And so I'm investing with the perspective that there is not going to be a stock market crash anytime soon. So I'm cautiously optimistic that the market will continue to grow, at least in the near term. Now, I could be wrong and there could be an imminent stock market crash very soon, in which case I'm fine with that. I'm okay with the market correction in the short term. and those are great buying opportunities as a long-term investor. Practically speaking, I'm going to continue dollar cost averaging into my retirement account where I'm holding an S&P 500 index fund. And if you are interested in learning more about what you should expect from investing in an index fund during market record highs, be sure to check out this video right here. I'm also going to continue dollar cost averaging into my dividend portfolio where I hold a basket of dividend ETFs. And if you're interested in learning more about how to build the best dividend portfolio, be sure to check out this video right here. And finally, I am investing in some individual stock positions where, yes, the stock market is overall expensive, but I think there's sectors that are actually at a discount because of COVID, and it's continued to impact those industries. So if you found this video valuable in any way, be sure to hit that like button down below. Don't forget to subscribe and hit that notification bell so you don't miss out on any future videos. Thanks for watching, guys, and I'll see you guys at the next video.